Welcome to It's No Secret, a podcast for those who want their money questions answered.
Join us as we talk to real Kiwis and share truths about our own financial lives, because the truth is, there is no secret to achieving financial freedom.
Lovely listeners, welcome back to another episode of It's No Secret. For those frequent listeners, I'm obviously neither Kat or Christine, so I thought I'd do a little bit of an intro. My name is Tim. I'm usually the guy behind the camera who produces the show, but one of my New Year's resolutions is to be more out there, so here I am. Today, we're joined by Kernel Founder and Chief Executive, Dean, to chat about the topic on dividend investing in New Zealand. So there's a bit of an allure with creating a passive income, Dean. It attracts many people to investing. That was one of the main reasons that I was like, oh, this looks really cool. And when I was getting really into investing during COVID, this is actually one of the first few things that I was like, oh, wow, dividend investing looks like that's it. Like
the passive income.
The passive income allure, like all the YouTubers, be like, oh, this is the best dividend stock. Yeah. This is the best ETF. You've heard it all. But yeah, since then, I thought that this trend may have stuck with like a few people. Like maybe that's
been a long-term trend, particularly in New Zealand. And, to exactly your point, you've had people really interested in like passive income. You've had the FIRE movement as well. So there's this allure to the idea of kind of having this income that you're not having to work for, right? Yep. But what we're going to cover is maybe a little bit of the reasons why that's not the best approach to actually maximizing your wealth and generating an income.
Oh, exactly. So I guess we can kind of get the ball rolling with, so what are your thoughts on making, on those looking to make a passive income stream through dividends? What are the things that you kind of say to those people?
So we've done a lot of deep dive into this.
Yep.
We talk about it quite a lot generally internally. We see it in the market. And I think it's important to kind of get some context about why do Kiwis love dividends? Why do we like to look at dividend yield and the yield of investing generally, right? And this is something that goes back generations, actually. It's not a recent phenomenon. We actually kind of have this underlying culture in New Zealand around looking for dividends and yield. And you can go back right to the 1980s, kind of post the 87 stock market crash, a bit of a Wild West market back then. The regulations were really light. That put a whole lot of people off investing generally for a very long period of time, particularly in the share market. But what happened then was actually we had the introduction of the imputation credit regime, which effectively meant that the tax that companies pay provides credit so that you don't have as much tax to pay on a dividend that's paid out. So it makes dividend income relatively attractive for an investor. But on the back of that, I guess we've formed this culture where people have gone, right, we really like income. Kiwis have a lot of money in term deposits. So I was just checking these stats. So a couple of years ago, resident Kiwis had about 159 billion in term deposits. That is now over 200 billion.
Wow.
So Kiwis have today $200 billion sitting in term deposits where they just really love the safety and security of income, right?
Yep.
The New Zealand share market has predominantly been made up of kind of not slow growth, but more stable, utility type companies that have a really high payout ratio. So when we talk about dividends, a company makes profits and it can either choose to reinvest those profits into its growth and innovation and investment, or it can pay those out as a dividend. And so in our research paper that we covered, we saw that about 82% of post-tax income was paid out as dividends in New Zealand, compared to the global average is about 48%. So companies in New Zealand typically are paying out higher dividends. So we've typically had a higher dividend yielding market. So as a percentage, for a long time, you would have thought New Zealand equities paid out sort of about 5.5% dividend yield versus global shares, US shares, sort of 2%, right? And that's quite easy to understand, right? You look at big US tech giants, they continue to reinvest. They don't focus on paying out income. They're building long-term profitability and growth. Yep. So that's kind of what's been going on. I think there's some really scary really scary elements as well to Kiwis' obsession with dividends and where it's got them caught out in the past. And so finance companies are a really good example. Particularly older generations who like the security and idea of going, okay, I get this regular income, get caught up and have been attracted to investment opportunities that are perceived to be safer, but can actually be quite high risk. And so finance companies were a great example. You had these finance companies offering steady income 8, 10, 12%. But they were ultimately using that money to invest in potentially some quite risky assets, and we saw the implosion of that.
Yeah.
And so a lot of people lost a lot of money. We've seen some recent examples, even in the last 18 months that we've been talking about in the paper, where a couple put $750,000 into one single property syndicate.
Oh, yep.
That property syndicate froze and was no longer paying out a monthly income, and also they were unable to get their money out. So we're seeing it again now, like where I really kind of want to wave the flag and caution people. You see what's called wholesale investment options.
Yes,
You see a lot of these in the print and the newspaper, and it's kind of accelerated in the last few months, actually. Property development companies and others where they are financing property, and they offer the 8 or 10% fixed returns. Now, you technically have to be a wholesale investor, but actually a lot of people can kind of comply with that.
So what's like the limit to wholesale?
It can depend on either you're an eligible investor or wholesale, so it depends on your experience or asset level. But again, you have a lot of people who may have retired, sold a big house, who actually have plenty of money. But what's concerning is they tend to go and put it all in on this wholesale fund. Now, what people got to realize is that when it's a wholesale investment, that's not like, some exclusive next tier up, I'm now in a new category, this is great. Effectively just means that you have no protections. So there's no independence of the custodian, there's no supervisors, you have far less regulatory protection. So the things that likes of Kernel that we have, we're a retail offer, the product disclosure statement, independent custodians, independent supervisor.
There's all those safeguards,
all the safeguards of the FMA, you don't get that with wholesale. And so you can kind of do what you like as a company, right?
So is it up to their discretion to like how much they report on that kind of thing? Yeah, that's pretty scary.
So that wholesale label is kind of a bit wrong. So that's sort of, I guess, a bit of an overview, right? That, Kiwis for decades now have a real focus on dividends and yield, but often it can catch you out either riskier assets or it's not maximizing your long-term growth. And we'll kind of get into the tax around that. But yeah, New Zealand generally has that market. I think what worries me a little bit with it is not only those that may be close to retirement with large balances going into wholesale funds and putting all their eggs in a single wholesale fund, you're also seeing a lot of younger investors loving to post about dividends. And what we did recently was a paper to look at, well, actually, if you're young and trying to build wealth, is there a better way to maximize your long-term wealth, but also get to a point where you can have a passive income?
Yes.
And how would you do that? So that's what we've kind of looked at.
Oh, that's great. So I guess like one of the follow-up questions that I have there is like, since New Zealand companies are so much higher with their payout ratios, do you think that kind of hinders the New Zealand economy in a way of like?
So it tends to reflect the New Zealand share market in particular. If you think about how that process works in the markets at a high level, you'll have a company that may want to IPO and list on the stock market. To do that, it typically will try and have the support of some of the broker communities and the investment bankers to try and take that to market and get people to become new shareholders in that business to raise capital. But we have a lot of quite big legacy companies, your Meridians and your Contacts, and these are stable, good investments. Like they tick along, they're stable companies. They have a good dividend payout. They're not necessarily going to be the fastest growing companies, right? And so it kind of makes sense that they will recycle more of that out to an investor via dividend because there's less opportunity for them to internally reinvest that money to drive more growth. I think what we've seen though, and many people have invested locally or been familiar with the local stock market, so is our culture around dividends means that often, even in the financial sector, we don't appreciate or understand growth companies. And so New Zealand doesn't really have these great big tech stories that you have in the US. But actually we produce a lot of amazing technology companies. Xero is a really good example. Xero is a global Kiwi success story, a multi-billion-dollar company that's made fantastic results for many of its early investors. When it listed on the stock market here, it really had hardly any support. And a lot of the brokers didn't really appreciate or understand technology companies, their growth potential. And eventually Xero delisted from the New Zealand stock market and is now listed on the Australian stock market because the community there has much more support and understanding around technology and growth companies than locally, where a lot of the brokers are trying to ultimately sell to their clients dividend companies.
Yeah.
So, we've missed out a little bit on these great Kiwi technology and growth companies that often, rather than coming and listing on our stock market now, simply sell to offshore investors or list on offshore markets. Rocket Lab is not listed on New Zealand stock market.
Right.
Xero is no longer listed on New Zealand stock market. That's a good example of where kind of the downside of our culture, and even in the financial sector's culture, we're missing out on the bigger picture here.
Okay. Oh, that kind of sucks that a lot of companies just go overseas and list there. Yeah, so that's not... missing out on some gains. There's a lot of capital growth opportunity for
there's definitely
investors
some pros and cons of investing for dividends, right? And I think maybe we sort of break down what does that look like. And so the thing that a lot of people get attracted to, the idea they get attracted to dividends, is seeing that cash come into your account as an income and go, right, I've received a dividend. And as you build up your investment portfolio, if you're regularly investing and you're thinking long term, every quarter, typically a lot of Kiwi companies will pay out, say, quarterly. Every quarter, that dollar amount gets bigger and bigger.
Yep.
And so that's quite attractive to people, because then they start to do that mental math of going, hold up, if I build out and I have enough companies, I can get this income every month, and at some point, maybe I don't need to work. That's a lot of the dream, right? It's why we try and build financial security, so we have choices, and maybe we could take a different job or travel more, spend more time with the family. So that is the attraction of the dividends. But the downside with dividends generally is they're not always predictable, right? Yes. And so a lot of companies will be relatively stable, but dividends are inconsistent because a company's profits may change,
right,
and their dividend policy may change. So in New Zealand is a good example of how that policy changed. And so the company historically used to pay out a fairly set amount of cents per share as a dividend. Then they changed to a percentage of their earnings. And so if they had a really good year, that dividend may be quite high. But then there was periods where obviously recently they haven't done so well. And all of a sudden that value or those dividends have dried up or ceased to exist, right? And so the trouble with dividends and trying to build up a passive income is that you may have a lot of inconsistency with that income. So if you think about that future state and you've got a big enough nest egg and now you've got these regular dividends, what do you also want? You probably want to be able to predict your income. You've had a salary, you want to be able to know what's coming up, particularly if you've got other expenses. And the problem with dividends is you don't have that control and you don't have that predictability over how much income you may get each time.
Oh, that makes sense. Well, what about, like, say, capital growth when it comes to dividend companies?
So this is when you have to start thinking about all of the elements that eat into your returns. Now, historically, higher dividend paying companies tended to be less volatile. So by that, we mean less up and downs in terms of the share price, because they tend to be a bit more stable, mature companies that have long track records of paying dividends. Again, your Meridians and others. So the total return may not be as big because they're less up and down and they've got a regular income. Whereas if you were invested towards more growth companies, particularly over the last few years, you've had a higher total return because they've been able to grow their revenue faster, grow their market share faster, they're innovating, etc. And so your total wealth has probably grown faster in growth stocks that aren't paying dividends than if you're investing solely in dividend-paying type companies.
Okay, gotcha. Okay, cool. I guess, what else is there? So what if you were to kind of like reinvest those dividends instead of kind of just cashing them out?
I'll do tax quickly.
Okay, let's do tax. Yeah.
Because this is quite the key point when we come to the...
Oh, yeah, we'll do that at the end.
So the other... So if you think about... So investors looking to build that income, it's like, okay, just like with earning a salary, there's tax to consider, right?
Yes.
And this is something else you may want to consider around, it's not just about dividend investing, but it's about generally how do you hold your investments. So one of the benefits in New Zealand is that we have a relatively simple tax regime. We don't have capital gains tax on shares unless you're trading. Caveat, there is actually technically a capital gains if you are trading regularly. But we have what's called the pie regime, which is where a fund, like the funds that Kernel offers, are taxed at your prescribed investor rate, PIR, rather than your resident holding tax rate, which is the typical tax rate that you will pay on your income, your salary. Now, the benefits of the pie funds is not only are you diversified from the first dollar, is that tax is capped at 28%. So if you were investing directly, then you may have tax at 33 or 39% on holding direct shares. So it's more tax advantageous to hold shares in a pie regime for many investors than maybe holding shares directly. So that's one thing to consider. Because again, when you think about that tax return and that income, you're paying tax on those dividends and incomes. You want to try and ultimately end up with the most net amount of income after all those expenses, including tax. So that's one thing to consider. And we'll sort of talk about how do you look at optimizing for dividend and passive income soon.
Nice. So with that bit there, actually, with the capital gains side of the conversation, is that only applied to New Zealand shares, or is that everything that's under
No.
pie?
So you potentially have capital gains tax by trading, depending on your threshold. And the way that tax is calculated in a fund is depending on different, whether it's in New Zealand shares or whether it's offshore shares. We've got some great blogs on tax, and we've done a couple of good sessions on tax. So without getting too technical on it, encourage you to read some of those other blogs that we have at Kernel. Look at our tax guide, helps break down some of those nuances. Long story short, though, for an investor, the benefit of the pie regime, the way the Kernel funds operate, is all of the tax filing is taken care of on your behalf. So you don't have to consider any of those nuances. You don't have to do filings for tax credits or anything else. Like that is kind of all taken care of within the fund.
Cool. Great. So I guess this kind of brings us to the whole conversation about reinvesting those dividends versus cashing them out.
Yeah.
So are you able to kind of give us an example of how that goes?
Yeah. So if we think about what people are trying to achieve by their interest in dividends, right? Often it's about a future passive income, So people are still investing, they're building up their portfolios. They're not living on those dividends today. They're trying to get their portfolio and balance to a point where they could maybe live on those, right? So what many investors are trying to do then is probably go, right, they'll get those dividends, but then they'll want to ultimately try and reinvest them anyway to buy more shares for a future state. And so owning direct shares, you have more costs with that, because if a company pays out a dividend and then you want to ultimately buy more shares, well, then you're going to have more brokerage fees and expenses to go through trying to reinvest that. And so you end up basically having lots of little slithers of your income
Slowly getting chipped away at.
eroded at, rather than kind of being able to have that automatically building over time. And I think probably it's important for people to appreciate that what typically happens as well with the dividend is that, say the share price was $1 and the company is going to pay out a 10-cent dividend, that's not free money that's magically come out of thin air. It's part of the assets of those companies yesterday, and now it's just going to be split out. So when the share price was, say, $1 and the company goes, right, we're going to pay out a 10-cent dividend, in simple terms, the share price tomorrow, once that dividend is paid out, should drop to 90 cents because the money that was sitting inside the company and is now being paid out, it's just cut it a different way. And then you can choose to go and buy more shares or take that money. Your total wealth hasn't changed, and you haven't just received this free money. But I think people think about dividends as almost being this extra return that didn't exist and has come from somewhere else. Really, that isn't the case. It's just deciding where does that money go, and the company's going, rather than us continuing to hold that money in the business, we'll give it back to investors. So you've got to appreciate that there's not free money. And so when you are looking to then build your long-term wealth, that reinvesting over the short term can come with a lot of costs. And so what we tried to do was we did a blog paper looking at this, and we just kept it relatively simple, looking at the New Zealand shares. And we looked at, okay, taking a diversified mix of buying a bunch of direct shares directly and then choosing to reinvest those dividends compared to, say, just holding an index fund that does everything automatically. Because obviously the index fund has a management fee, so there's an ongoing cost, relatively small. versus buying direct shares, you don't have that, but you've got to take into account tax differences and the brokerage fees you're going to pay each time. And what we found actually was that in a lot of those scenarios is that actually you're better off being in a fund that automatically can reinvest for you and avoiding a lot of those big brokerage costs to build your long-term wealth. And so we've got some great tables that can show the difference that investors can go and look at and have a look at that example and go, okay, I can start to make sense now of, should I be buying direct shares? Or simply, should I invest in an index fund and let it work hard for me and build up its value over time? And then at some point, I want to start to take an income. And that's where we go, actually, maybe there is a better way to get an income, which is not dividends. It's actually simply selling some units on a regular basis.
There you go. I guess it kind of goes against the whole mentality. After like accumulating for like, let's say 20 years.
Yeah.
When you do get to that point, it does go against like every bit of you. Just like, oh, I need to start settling down. And I guess that is kind of the main thing that people
this is
don't like to do.
What we sort of like, the alternative way to passive income through dividends is simply owning units in a fund and selling shares on a regular basis. So let's break that down. What we've highlighted in some of this research was to sort of help people understand actually, how can you build more wealth and end up with a regular income? And what's the best way to do that? And remembering that because this dividend isn't free money, you have the option of trying to buy a bunch of direct stocks and have inconsistent income. You know, it's not predictable. You're going to rely on whatever dividends the company decides to pay out on whatever basis that they pay out. Or you can remove all of that hard work and go, right, I'm going to invest in an index fund. I'm going to automatically have it all reinvested for the next 10 to 20 years. And then at some point in the future, I go, right, I now want an income to top up my retirement or to live off. And what you do then is, rather than wait for a distribution from the fund or the equivalent of a dividend from a company, you go, right, I want to get $100 a week. That's what we're going to have our budget and we're going to live off. And you can simply say, right, I'm going to sell the value of $100 out of my fund every single week. And that is going to give you a really steady income. And the benefit of that then is actually you have more consistency of your income, and all of the tax is taken care of and optimized as well effectively. So the nice thing, because of the PI regime in New Zealand, is unlike, say, if you were in the US, so a lot of people may read about dividends and why dividends are attractive and passive income from US sources.
Yes, yeah.
Where there's quite a different tax regime. And so the income is beneficial because they'll pay capital gains tax in the US. So that's why you'll see you've got to be really cautious at times when you read a lot of, you know, US-based or Australian-based like personal finance content. It can be quite good, but you've got to remember it's a whole different regime. And the way that their tax system works is completely different to New Zealand. And so our tax system actually isn't that beneficial towards taking dividends because there's no capital gains. So getting your head around this comfort of selling some shares in your fund or units in your fund, it's a hard one for people to get their head around because you don't like to sell. But it's actually no different to simply receiving a dividend payout. You know, you're just taking some out of the pot and taking it out as cash rather than having it reinvested. And so, so Kiwi, if you want to build a passive income, what we're sort of highlighting with the sort of research was that simply build up your wealth through a well-diversified, low-fee fund. When you want some income, simply say, right, I want to sell $100 or $1,000 a week, and that is now going to be your income. And you have no tax work to do. You don't have to consider the tax considerations of it at all. It's all taken care of by the fund. And you can now plan that FIRE lifestyle of wherever you want to be living or whatever your lifestyle ambitions may be at that time.
Yeah.
So,
okay. So, like, I guess the question that comes to my mind is like, why? Well, what are the other alternatives if you do want an income, like outside of dividends?
Yeah. So I think what we highlighted actually was, I guess, to finish the key point was when we modeled that out, taking dividends versus selling down, somebody will end up with more wealth at the end still from a sell down of regular income than actually relying on dividends. So you're going to maximize your wealth as well as have a more steady income by taking this approach. Of course, what a lot of Kiwis tend to do is they get closer to retirement and they may not want to be in shares at all because they go, right, I want an income now and I'm going to start drawing on that money. And that's when they go and pile into term deposits.
Yeah.
That's why there's $200 billion in term deposits, because people go, right, I want that stability. Again, though, the problem with a lot of term deposits is you don't get a consistent income.
Yep.
It's not like you get something every month. Like some of them will pay out quarterly, but others will just pay out at maturity. And so you may have this long window and have a lot of work to try and, what people will do is called laddering. So they may have, they may put a term deposit down every single month. So there's always something maturing. What you've got to remember though, if you've got a reasonable nest egg now and you've got a bit of an income, you still want to make sure that some of that money is invested into more growth assets like shares, because you're trying to create income still 20 or 30 years into the future.
Right.
You know, you don't want that money to run out. And that's kind of the risk of going into more conservative like cash funds and putting all of your money into a conservative fund, in that if you are drawing down on that and taking that income, you may find that you start to run out of money as bigger expenses come up, rather than having some of it working into shares that can try and sustain your income needs 20 to 30 years from now.
So more like fixed interest assets, like bonds
so
and all that
what
kind of
people
stuff.
can do, what some people may want to do if they want to balance out that and balance out their risk, is go, we're going to split our money now into a couple of buckets. And so bucketing to create income is a really cool approach to sustaining what you need. And how you would typically do that is go, right, let's do some round numbers here. I've got $1 million. I want to try and live off that $1 million for the next 30 plus years in my retirement. We want to travel the world and do all the bits and pieces that we have dreamt about and worked so hard for, right? And so what you do is go, well, we need that. We need some of that money working for us to be able to give us an income in 20 years. We don't need it all right now. And so you may go, right, let's put 50, 60, 70% of that into diversified pot of shares, growth assets that typically have higher long-term returns. So you park that money, it's reinvesting and doing its thing over time. You may put a medium-term bucket into, say, a more balanced type strategy. And any cash needs that you have for the next couple of years, like your expenses for the next 2 or 3 years, you may put into a more conservative, like a cash fund or something like that. And you are drawing from that cash fund bucket, so that first bucket. So you may have 100 grand or 200 grand that's sitting in that cash bucket, and you're taking out income from that and using that to fund it. And then every couple of years or so, you'll basically move some money down the pots. So, So some of those growth assets now you can move down to a more balance, and then balance into the cash, and almost have this little waterfall of maintaining these pots of money. And so that way, you've got control over what you may need in the short term. It's going to be there as you need it, but you've still got assets that are working for you to sustain the income that you're going to need 20 years from now. So the bucketing approach is another way to think about how do you split the money to create passive income and to sustain your long-term income needs.
All right, Dean. So let's get some key takeaways here. Let's say you can go back in time and tell 20-year-old me about dividend stocks. What are the things that what are you gonna say?
If you are young and wanting build that long-term passive income, stop worrying about dividends. That's the key takeaway here. Dividends are irrelevant to building long-term wealth and passive income. And so if you're wanting to achieve those things, there's a much better way to do that. And that's thinking about diversified funds and selling units in a fund on a regular basis. Completely different mindset. It's going to take a lot for Kiwis to change that mentality about thinking about what's the yield, what dividends am I getting, to going, actually, none of that matters. It's just one big pot of money. So if I have that pot of money, how do I make that pot of money work the most efficiently for me? And the benefit of New Zealand and how we operate, and that we're not the US, so don't worry about US personal finance blogs, is that you can be in a diversified index fund and you can automatically sell down to create an income every week and have no tax to worry about in terms of filing or anything else, and have a much more consistent income stream, probably more likely to have longer wealth in your nest egg at the end, and you remove a lot of the admin and burden. And I think the other big thing that I would love to see on that is if we shift a lot of, particularly closer to retirees, mindsets away from being tempted by these wholesale funds that are really playing on people's emotions with the idea of these sort of 8 and 10% guaranteed returns. Nothing is guaranteed. They're much higher risk than people appreciate. And so we've really got to change our psyche around how do you think about wealth? How do you think about income? And the blog that we did and that you'll be able to link to is a really good summary to highlight a whole new way to think about building passive income. And it doesn't involve dividends and doesn't have to worry about yield.
Excellent. So yeah, we'll link the blog that Dean's been talking about into the show notes, so you guys can just see that in the description below. And yeah, with that, big thanks to Kernel for enabling us to do what we do. Don't forget to hit like and subscribe whenever you're tuning in, whether that's video on YouTube or listening to Spotify or Apple Podcasts. If you have any questions, feel free to just hit us up in the DMs or send an email to support. All right. Thank you so much, Dean.